All right, in this lesson, we are going to talk about one of the four financial statements that we talked in the last lesson. And in this lesson, we're going to cover the income statement. So let's get started with an overview of the income statement. The income statement provides an overall picture of a company's profitability. So if this sounds familiar, this kind of goes with that net income calculation that we did a few videos ago. That's exactly what we're talking about here. Now, the income statement is a combination of the revenues and the expenses a company incurs during the course of the period of time that we're preparing the income statement for, whether it's annually, monthly, quarterly, or semi-annually, however we're preparing it, we're going to summarize the revenues and expense. Now, what you need to know here is that we have all of these accounts. And so we told you that we've got 6 buckets here, right? We've got assets, liabilities, owner's equity or owner's capital, dividends, revenues, and expenses. So when we talk about the income statement, we only care about the revenues and expenses. And we also said that each bucket has a whole bunch of accounts. And so an income statement lists all the revenue accounts first and then all of the expense accounts afterwards. So we're going to list all of them out to get to our net income or net loss. So that's what we're doing here. Now, that net income equation is an important one. The income statement is based on the net income or loss equation. So the net income or net loss equation that we talked about in the prior lessons was revenues minus expenses gives us net income. So to give you an example of what an income statement looks like, now this is a different view of it, but same kind of theory behind it. We're going to look at a lesser known company. You might have heard of them. They're called Facebook. So we're going to look at Facebook's net income statement. Now, there are some things that are a little different here than kind of the basic, and that's because they are a big global company, and so they have to follow complex rules. You're in a foundational accounting course, meaning we're just teaching you about this, so you might not know all of the advanced things that are on this report, but this report at least helps you understand the net income or the income statement and how it's actually applied in the real world. So if you notice here at the very top, we've got the company's name and what this is. So this is Facebook Inc.'s consolidated statement of income, which is also another name for income statement. And notice here at the very bottom of the title, we've got in a million. So when you're reading this financial statement, when you see a 1, that doesn't mean $1. That means $1 million. So when you're looking at this, all of these numbers are reported in millions of dollars. Why? Because the shareholder doesn't care about the pennies or even the $100,000, because if you look at the numbers, they're so big that those $100,000 are not going to change the opinion of the user. And we'll talk about that later on. So notice here at the very top, we start with revenue. So revenues always comes first. In this case, we're looking at 2018's numbers for Facebook, and they did 55, not 55,000, $55 billion in sales or revenue. So $55.838 billion of sales. So that's the revenue. So revenues, and now we need to subtract expenses. So down here we have all of our expenses. Now again, there's some other things below it. We won't be too concerned with them right now, but we've got all of our expenses. So cost of revenue. Cost of revenue would be the costs associated with providing the services in which they are getting actual revenue from. So for instance, it might be development cost of putting things on the ad space on Facebook. It may be the salesperson that has to call these businesses to get them to sign up to put their ads on Facebook. So that's cost of revenue. We've got research and development. So a company like Facebook is doing a lot of research and development. Shoot, they're doing $10 billion of research and development. So that's a lot of money there. Marketing and sales, $7,846 million. And then general administrative, $3.451 billion, for a total expense of $30.925 billion with a B So we've got revenues of about $55 billion. We have expenses about $30 billion. If we subtract that, we should get about $24.9 billion of income. Now, there's some other things here, but I'm going to go straight to where it says net income. So these other things are more advanced accounting stuff, so we won't talk about them here, but you'll learn them at some point. So net income here of $22.112 billion. So revenues minus expenses gives us a net income of $22.112 billion. That's the information we as an investor or stakeholder are going to need. So we're looking at this and we're looking, okay, last year they did $15.9 billion in net income. This year's $22.11 billion in net income. It looks like they're on the upslope, so I'm going to go ahead and invest. And we said that we're providing these financial statements to external users so they can make decisions on whether or not they want to invest, hold, or sell their positions in this company. And in this case, you're looking at that, you're going, I'm probably going to hold my investments and maybe buy more, assuming that next year they can grow to maybe $27 billion of net income or whatever it may be. So this is going to give those external users information about the company and whether or not they want to do something about their investment. So an income statement also is not necessarily a cash flow statement. So when you're looking at the financial statement of Facebook, for instance, $55.838 billion, it's important to know that the total sales, the total revenues doesn't necessarily mean total cash collected. There's a difference because some companies allow their customers to pay their bill after services were rendered or goods were delivered. We call this the credit line. What do we mean by this? So think about you going to the store, right? So you go to the store, you grab things off the shelf, and then you head to checkout. The checker's there, they scan everything, and then they total it up. So in that case, do you ever just give them the stuff, they scan it, and then you put it back in your basket, and then you just walk out the door? Probably not, right? You have to give them something. Some monetary exchange has to happen, whether that's card or cash, in order for you to walk out the door without handcuffs, right? So how do you do that? Well, you give them cash, or you give them a debit card or a credit card, and then they swipe it, and then you get to leave. And so you have to pay for your stuff before you leave. So if their revenue is $1,000, they would have received $1,000 in cash or credit card, and then they're done. So that would be a cash statement. The problem is when corporations deal with other corporations, not necessarily the public, they trust those corporations a little bit more to pay them a little later. So for instance, if we switch the example here, a company like Coca-Cola, who has a pallet full of Coke, will deliver that to a Target, for instance, and the driver doesn't ask for payment when they leave, they literally just deliver it and leave, okay? And so what happens is Coca-Cola will tally up all the delivery costs or all the deliveries that they made to a Target, for instance, and then consolidate that bill to one bill. And then at the end of the month, they will send a bill for, let's say, $215,000 to Target. So it's a little bit different than us going to the grocery store and buying something and then having to pay for it and walking out. For a company like Coca-Cola, they're going to bill them at the end of the month, and then they'll get payment later on. So for instance, on December, let's say 31st, Coca-Cola prepares the bill for all the Coca-Cola that they deliver to Target, and let's say that's $200,000. That $200,000 is going to show up on their income statement because they've earned it, right? They delivered the goods, so they've earned the $200,000. They're going to put that on their income statement as revenues, even though they haven't received the cash. When are they going to receive the cash? They're going to receive it maybe in January. So we're going to record $200,000 of revenues now, even though we haven't received the cash. And that's okay. That is part of the rules. That's an okay rule here when we talk about accounting. So it's important to understand that the total revenues and the total net income and the total expenses do not necessarily mean total cash collected, because we might have earned the revenues now, but we'll collect in another period, and that is okay. So when you look at, let's say, Facebook here, when you look at this Facebook here, it doesn't mean that they had $22.112 billion in cash available. It means that they earned a total profit of $22.11 billion, but they may have gotten less because of the $55 billion of revenues they have. They may have only received, let's say, $50 billion, and they're still waiting for $5.8 billion to come in. On the other side, there's expenses here like general and administrative of $30,925,000. That doesn't mean that they paid $30,925,000. It just means that they incurred the expense. They may have to pay it later on. A great example of that is if you're an hourly employee. So if you work the last week of the year, you typically won't get paid on 12/31, but you've earned the pay, and so the company has an expense. They owe you that week's pay, and so they will book that expense even though they haven't paid you for another 2 weeks. Same thing here with the expense. So it goes both ways, revenues and expenses. So that is a look at the income statement. Just know that we start with revenues and we subtract expenses to get to net income. And once we're at net income, that's the number that we want at the very bottom of that statement that then flows to the statement of retained earnings. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it's Patrick. Before you skip ahead to the next section, just wanted to come on here and tell you to not forget to like this video and maybe share this video with someone that you know that would get a lot out of this lesson. Maybe a classmate that you know. This would be a great way to introduce them to this channel. So share this video with them, maybe your mom or your dad, someone, so that they know that you're really learning accounting topics here on YouTube and you're not just playing cat videos over and over again. Now, if you want to help us grow this channel, what would be great is if you press the subscribe button and maybe even turn on the notification bell if you want to get alerted the next time we upload a video to this channel. And put in the comment section below, what did you eat last night? It would be so weird for people to come and look at the comments, but what did you eat last night? I might throw in a comment after you if you put that in the comment section below. So do that now. What did you eat last night? All right, so enough of the fun stuff. Hope you enjoyed this lesson, and we'll see you in the next video.